Hey guys, it's Willie. Today I want to take a look at Roper Technologies. I'm currently trading at 432.31, down 8% in the past day. That is terrible. Why is it not giving me the 6 month number? Wait, no, it's 8% the 6 month number? Yeah, I'm sorry. What does it say today then? 8% over the past 6 months. Over the past day, it's down percent. Okay, that makes more sense. I was confused. So, down 8% over the past 6 months. Really volatile chart jumping around in there. So, one interesting thing I do want to point out, Roper Technologies is an American diversified industrial company that produces engineered products for global niche markets. Which is something I'm like, huh? What do they do? So, apparently they do sort of like the engineering service, and they do engineering services for other companies, and they do software as a service sort of stuff. Initially I was thinking of like Roper, the people who make washing machines. You know, I'm always looking for those boring businesses. You know, washing machines are pretty boring. So I'm like, oh yeah, Roper, they make washing machines and appliances and stuff. Well, no, that Roper is owned by Whirlpool. Stupid. So I didn't know that Roper was a completely different company. However, the screening analysis that we always do is going to remain the same. The only issue that you would run into with the screening process would be with, I think you would run into issues with banks. I think you would run into issues with insurance companies. REITs are weird. You have to value those sorts of companies. You value them differently. This sort of company is still A-OK as far as our analysis process. So let's jump over to the spreadsheet and see if we want to buy it at the 432.31. So again, stock ticker ROP, Roper Technologies, 432.31 is the current price. Revenue growth, net income growth, free cash flow growth, looking pretty good. Revenue at about 7%, net income at 9%, free cash flow growing at 8%. Good job, Roper. Even though I confused you for a washing machine company, you're doing pretty good nonetheless, growing revenue and net income and free cash flow. Shares are going up, which anybody who has viewed the channel before knows that I don't like that because it dilutes us as a shareholder. However, in this instance, I'm not as concerned going up only 0.68% a year over the past 10 years. I'm not that concerned about a number like that. If it's if it were doubling every year, yeah, I'd be a bit concerned. But this sort of rate I'm okay with. Earnings per share, free cash flow per share, growing very well. EPS is at 8.36% a year. Free cash flow per share, 7.33% a year. Assets growing. If you're wanting to look at assets, here they are. I don't really care much about assets very often. I'm looking more at cash flows. Dividends, there you are. A really good sign of a strong company is the company that increases their dividend every single year. Even if it's a little bit, increase it every single year. No cuts. This kind of shows you the direction that the company is going, and a raising dividend every year is a good sign. Just like Coca-Cola, Pepsi, those are really good companies that raise their dividend every single year. And that's one reason why Buffett makes back on Coke. He makes back his initial investment every 2 years, I think, the last time I checked. Just in dividends alone, he makes back his initial investment. Yeah, so that's why we look at dividends as a driver of value. Total debt has gone up pretty quickly, 13.86% a year over the past 10 years. That's a bit concerning because debt has gone up, cash has come down, so your net debt has gone up. Looks like there was a big acquisition in here. I would guess that would be an acquisition. Maybe an acquisition here too. Maybe. Something there. Something to look into. ROIC, looking pretty good. You're looking at 8% over the past 10 years. In our metrics tab, ROIC 5 years has been 8%. I think that's close enough to 9. That's okay. I wouldn't freak out about that. However, my big concern with this company is our pricing metrics with our PE, 5-year PE, price to free cash flow, 5-year price to free cash flow, all in the big major reds. Basically double what we were looking for in a company. Your debt's a bit high, but I think they've got solid free cash flow. I think it's stable enough that I would feel comfortable with this sort of number. As long as they're not going to keep increasing and increasing and increasing at the rate they have been with the debt. Something to look into again. 5-year revenue growth positive, earnings growth positive, free cash flow growth positive, shares outstanding going up, but not at a rate at which I would be concerned. ROIC 8%. So, free cash flow growth, I assume 7%, multiple of 15, 382.66 in 10 years as a price, 7% for net income also, which is a bit conservative on the numbers, but it is more aggressive than I think I would normally be. Price free cash flow, PE 15, we get a price of $318. Over here we split our difference, looking at $350 in 10 years. Our current price is $432.31. We get our free cash flows here. We're out at $350.31. We get a 3% annualized rate of return based on a IRR basis. I think that's low. That's obviously low. I think it would be a situation where I'm not buying it at this price. However, I think this is a really good business. It could be something you could add to your watch list and see later on when it falls. Pick it up then, because I think you're seeing good growth out of the company. I think you're seeing, reasonable decisions and financial decisions being made by the company. Issue a few shares, because frankly put, at this overpriced level, if I own the company, I'd be issuing shares like crazy just at these overpriced levels, because why not? I can get people to overpay for my shares and get financing that way instead of taking on debt. I mean, you would do that. As long as you can reasonably ascertain the value of the company and say it's overvalued, well, issue some shares. Why not? Get more money in the company. Dividends are growing, good, strong outlook for the company, revenue, all that stuff. Looks really good. I think this looks like a good company. The debt's a little high. I'd like to see something happen to bring that down. Maybe issue some more shares to put it toward the debt or something. But that's a discussion for management. I do not work for this company or anything like that. So I don't make those sorts of decisions. 3% IRR is not something we're looking for. However, we want to keep a list of good companies on our watch list to say when it falls enough, we'll get in. Unfortunately, I think this company has to fall to what amounts to being in half. So from 400 to 200, you're looking at 15%, which is where I would be buying. I'm not buying to get a market return. I'm looking for above market. About 15% is really what I'm looking for, if not more. But 430, 231 is just too expensive for me. The debt's a little high. But anyway, I think this is a really good company to add to a watch list and keep an eye on it for later. But beyond that, comment down below if you guys have any ideas of what stocks you would want to see me go over. I'll try to read them and comment on them as much as I can. Do your due diligence, like, comment, subscribe, all that crap. I feel like I'm repeating myself like over and over and over and just wasting everybody's time doing this. But yeah, put comments down below. Comment anything, any sort of constructive criticism or anything like that would be helpful. I'm always looking out for ways to make this channel better, the videos better. But beyond that, I'm going to end this video here, and I will catch you guys in the next one.